Hello everyone, once again welcome you to your own channel. I, Argo Chatterjee, a banker, founder of neverendingwealthcommunity.com, an YouTuber and the writer of the book The Secrets of Never-Ending Wealth. Let me welcome you to your own channel. In today's video, I will be describing some factors that you should consider to predict the upcoming market crash. In this video, I will be describing the US economy and Indian economy side by side, and I will try to find out whether the market is really overvalued or is there any chance of market crash or not. By the way, if you have missed out the cryptocurrency and the blockchain video series of mine, kindly click the I button appearing above this video so that you can go through the entire process from A to Z of crypto investing. So without wasting your time and time of mine, let's begin. The first indicator that need to be considered to find out the market crash is market cap to GDP ratio. Some people call it Buffett indicator. It helps us to find out whether the market is overvalued or not. In this indicator, the total market capitalization or the market cap is divided by the GDP of that country. If this ratio stay in between 75% to 90%, then we can say that the market is fairly valued. If this ratio goes beyond 90%, then we can say that the market is overvalued. And if this ratio goes down below 75%, then we can say that the market is undervalued. And this undervalued market is a perfect time for investment. And if this ratio goes beyond 100%, then people should be worried, because at this moment the market will be considered as highly overvalued. In this overvalued market, the chances are there that you will lose your money. Currently in US market, this ratio is standing at 215%. That is almost 67% higher than its historical trend line of 120%. And 215% mean the market is not only overvalued but extremely overvalued. In India, this ratio is standing at 122%. That is almost 13 years highest range. That also suggests that not only US but the Indian market is already at very overvalued situation. The next indicator is price to earning ratio. If you want to know what is P ratio, what is PB ratio and many other fundamentals, then kindly visit the video appearing in the I button. And in this P ratio parameter, you can see that the S&P 500 is maintaining its P ratio of 30.19. That is quite high, and if such situation happen, that means the market is absolutely overvalued. Basically, the ideal range of price to earning ratio is 20 to 25, and if it is trading more than 25, that means already the market is overvalued. In 2000, during the tech bubble, this ratio already gone up to 45 level mark, and then the entire market collapsed. That means if you see the price to earning ratio is high, that truly indicates the market is highly overvalued, and the chances are very high that the highly overvalued market will crash any day. But here is a good news for India, because the P ratio of Indian market is 23.74. That is way inside the range of 20 to 25. That means as far as the P ratio is concerned, Indian market is not so overvalued like USA. The next indicator to be considered is price to book value ratio. If you want to know what is price to book value ratio, price to earning ratio and many other fundamental indicators that need to be considered before analyzing any company, then kindly click the I button appearing above this video. Presently in USA, S&P 500 is maintaining a PB ratio of 4.94. That means in USA, US investors are ready to pay 5 times the value of any company. That is very high. Similarly in India, the PB ratio of Nifty is now 4.31. That is also very high for Indian investors for investment. The next indicator is yield curve spread. Basically, yield is considered to find out the return of any bond, and the yield of any bond has a negative correlation with the price of the bond. Basically, there are 3 types of yield curves are considered in the economy. Those are positive yield curve, inverted yield curve and flat yield curve. If you want me to make a separate video on bond yields and how the bond market works, then kindly type bond and yes in the comment box. In this chart, you can see that whenever there is an inverted yield curve, the market has collapsed or entered into the recession right after the indication. And after the corona crisis of 2020, this curve was positively sloped. But in 2021, it again has started declining negatively. That is a main concern for the investors. The next indicator is Shiller P ratio. Actually, the usage of P ratio and Shiller P ratio seems quite similar except a major difference, and that major difference is in P ratio the price of any company or the index is divided by the earning per share of that company or index. But in case of Shiller P ratio, the current price of the index or any stock is divided by the 10 years inflation adjusted earning of any company or index. That means in case of Shiller P ratio, the inflation is considered, but in case of price to earning ratio, this inflation is not considered. In USA, the Shiller P ratio of S&P 500 right now at 40.21, that is way higher than its average range of 20 to 25 mark. The similar situation happened during the Great Depression of 1929 and the tech bubble bust of 2000, when the Shiller P ratio was quite high and the range of the Shiller P ratio was 30 and 45 respectively. But after that, the market collapsed very badly. As far as this indicator is concerned, the US market is highly overpriced right now. Similarly, in case of Nifty, this ratio is trading at 29.91. That is also very high for Indian perspective. The next and very important parameter to be considered is margin debt. Basically, whenever we borrow money from our brokers for investment, keeping our existing investments in collateral is called the margin debt. Basically, this margin debt has a good and bad implication in the economy. This strategy is very much useful when the market is positive and going up and maintaining its bull run. But whenever the market enters into the bear phase, this situation completely changes. As because the value of the existing shares goes down, the value of the collateral also goes down. And if this situation happens, your broker might tell you to give some extra fund or sell the stocks to close the deal. Higher the margin debt existing in the market, that much vulnerable the economy can be. You can see that whenever the margin debt has crossed the market has collapsed drastically. And the present situation is suggesting that the same thing is going to get repeated once again. That means at that time the investors need to be very cautious and very careful before investing, because whenever this margin debt goes above the index value, that means people are borrowing much than the actual value of the market. That means in near term, if the market makes any correction, then the margin holders will lose their money. In case of S&P 500, the margin debt has already crossed the total market capitalization. That truly indicates that most of the people have bought the stocks on the basis of margin money or on the basis of loan. If the market collapses, then chances are very high that all the investment value of all the investors is likely to go down. Another major area of concern is inflation. If the inflation is high, the chances are there that economy is likely to collapse very soon. In 2021, the inflation has already touched 7% mark for USA. The similar situation happened in 2008 and 2000, when the inflation was very high, and after that the market collapsed. In case of India, this number is under very much control. As you can see that from 2014 onward, the inflation rate has gone down below 5%. Basically, this inflation happened because of the excessive money printing done by the central banks around the world. Now, if we consider the total asset value of US Fed, Bank of Japan and ECB, we will find that trillions of dollars have been given in the economy as an economic boost, and that excessive money supply is the main reason for this high rate inflation. Then number 8, the real GDP number. As far as the real GDP is concerned, you can see in USA, after the crash of 2020, the GDP was improving gradually, and on quarter basis it was improving. But suddenly in third quarter, the GDP numbers has declined, and that is a main concern, because when the numbers are not so well, that creates the problem for the economy. Not only in USA, in our country also, the GDP numbers has started going down, and that is being reflected in the annual GDP growth rate of the country. But again, according to the analysts, these numbers are likely to be increased in future. That's a good sign for the economy. Number 9 is unemployment data. Now, as far as the unemployment rate of India is concerned, you can see on the 9th of May 2020, the total unemployment was 24.76% in India. In urban cities, the percentage was 25.30%, and in rural area, it was 24.52%. Now on 27th of November 2021, this number has gone down to 7.04%, among which in urban areas the number was 8.19 and in rural areas the percentage was 6.51. Presently, this number is 7.8% for total India, and in urban areas this number is standing at 9.2%, and in rural segment this number is standing at 7.2%. In USA also, this unemployment number is going down very sharply. That's a good thing for the economy and the investors. Number 10 is velocity of money. Through this velocity of money, it is trying to find out how the money is working in the economy and how the money is being spent by all the consumers to buy product or services in the economy. In simple terms, if you have $10 or 10 rupees and if this money is circulated among 100 people, then the total velocity of money of this 10 rupees would be 1000. That is called the velocity of money. That means how many times a single currency is being used to purchase goods and services in the economy. It is called the velocity of money, and it is calculated by dividing the nominal GDP with the money supply. Now through this chart you can get an idea that in USA the velocity of money is not increasing. That means though the money is being pumped in the economy, but the demand is not increasing according to the expectations. These indicators will help you to identify whether the market is overvalued, undervalued or fair valued, and through this process you can grow your wealth without taking much risk. But still another factor that most of the people believe, that is this time the market has recovered very fast, and within 6 months the market has already touched its previous high. That means the market has already recovered within 6 months. That is extremely fast. In case of Great Depression, this time was 25 years. In case of Black Monday, it was 2 years. And in case of dot-com bubble, it was 13 years. Now in case of financial crisis or subprime crisis, market took 5 years for recovery. And in case of COVID-19 or Corona crisis, you can say, market was down by 51% and the entire market was recovered within 6 months. Now as far as our analysis is concerned, this market should have been crashed much before. But why this market is not getting crashed actually? Because I believe there are two reasons behind this. Number one is low rate of interest, and number two is excessive money supply in the economy. These two factors are not letting the market going to bust. Till the interest rate in the economy will stay lower and the government will be pumping money in the economy, there is no chance of market crash. So that's it for today. In my next video, I'll be describing how you can invest your money so that you can evade the market crash or you can minimize your loss during the market crash. In that process, I'll be describing tri-layered financial mode that you should follow in investment. So till now, if you are here and not yet subscribed this channel, I would like to request you to kindly subscribe this channel so that you don't miss any video in future. So till then, be safe, be happy, bye bye.